Hello and welcome to 5-Year Club video number 147. I don't even know what to call this. Betterment mystery, Betterment investigation, who knows? Today I received an email from Betterment, and this is what it was. They said, your Betterment portfolio is getting stronger. What does that mean? Like, my Betterment portfolio is made out of, I guess, like businesses that have dollars, and dollars don't have muscles. So what's going on here? We're excited to bring you the latest optimization of the Betterment portfolio strategy. I like optimization because optimization's a word that sounds fancy and means nothing. Optimization. A betterment of the Betterment portfolio strategy. Our investing committee regularly analyzes, which is also kind of a meaningless word because it's so abstract, and continually refines, which is also a meaningless word. Our portfolio strategy is based on new data. What new data? Doesn't specify. Is it based on the cycle of the moon? And methods for improving expected performance. We conducted a goal-by-goal analysis, again with that meaningless analyzes analysis word, on your account, and are applying the update to the following taxable accounts. Safety net, which is my emergency fund. What more you need to know? No action is required from you. We just did a bunch of really vague stuff that we didn't want to give you any information about. And now we're telling you what you need to know. Lewis, you don't need to know anything. Just don't do anything. Just wait for it. Beginning on June 25th, 2018, we'll start to automatically adjust the investments in each of these goals. From today until the start of the transition, any deposits will help align these goals to the stronger strategy. Again, the more muscled strategy where the muscles don't mean anything at all because dollars don't have muscles, and mitigate any tax impact associated with the transition and mitigate any tax impact. So in other words, because it's a taxable account, they know they have the potential to create a tax impact. But they're not going to tell me in this email what that tax impact might be. They just have this kind of vague, we're making your portfolio stronger by adjusting investments. Why are they being so vague? Well, to find out, it says you can log into your account or read our white paper for more information on the updated portfolio strategy. Okay, that sounds good. Let's look at the Betterment white paper. The Betterment portfolio strategy. The portfolio strategy aims to achieve global diversification using modern portfolio theory. That's in capitals. As a basis for asset allocation. Betterment's tax management strategy starts at the level of the portfolio strategy via inclusion of municipal bonds for taxable accounts. Okay, they use municipal bonds to avoid taxes. All right. Our portfolio optimization includes tilts towards size and value. We don't say whether it's a small size or a big size. We just say size and value. 2 drivers of performance identified by the landmark research of Fama and French, who nobody knows. It's a mystery. 2 prerequisites for the Betterment portfolio strategy are that it must enable personalized planning and built-in discipline. What? What the hell did you do to my safety net? Betterment has a singular objective to help you make... What the hell did you do to my safety net? This is not telling me about an updated portfolio strategy. This is just blabbing on about some general stuff, right? So if we look modern portfolio theory, since it decided that that was important. So modern portfolio theory, this is what the white paper said, remember? Modern portfolio theory, it's like one of the first things they said. What is it? Modern portfolio theory, a hypothesis put forth by Harry Markowitz in his paper Portfolio Selection, published in 1952. 1952? This is almost a 70-year-old paper. is an investment theory based on the idea that risk-averse investors can construct portfolios to optimize or maximize expected return based on a given level of market risk, emphasizing that risk is an inherent part of higher reward. It is one of the most important and influential economic theories dealing with finance and investment. Wait a second. So all modern portfolio theory is saying is that you can construct a portfolio to match up with a risk/return disposition. And this idea has been around for 70 years. Well, that's not really rocket science. If you've got more bonds, you're going to have lower volatility and lower return. If you've got more stocks, you're going to have higher volatility, higher return. Maybe in 1952 that was news, but not in 2018. So this is not really helpful. It's got some interesting stuff in here. I read through it earlier today, and they go through like the different things that they hold. There are some kind of like red flags in here. For example, it'll say correlation between asset classes and the Betterment portfolio strategy, right? And then, and that's to show you that like bonds are uncorrelated with stocks, so they reduce risk. And then you look at the details and it says, this figure demonstrates the correlation of each asset class relative to each other using historical data from 2007 to 2016. That's not even 10 years. That's less than 10 years. That's nowhere near looking at, say, like 50 years of market data. Why would you base anything in this paper on less than 10 years of market data? That's crazy. That's like basing your investment philosophy only on the market's returns between 1999 and 2009. What? That was an anomalously low decade. Why would you look at a period less than 10 years? And then it just keeps going. There's some, I think, interesting. This one is the most interesting thing to me. And that's saying basically like, as you change your stock allocation, how do they change the bond allocation that matches up with that? So basically you can see once you drop below 40%, once you drop below 40% stock allocation, they hold like a lot more treasury bonds. They go really heavy on treasury bonds as you get even lower. So that's interesting because it shows how they adjust the different weights of things. It does show that the Betterment portfolio strategy is extremely simple. It's encompassed by this graphic, basically. Yeah. And then they've got some stuff like this where they're like, look how much better we are. And then you read through it and you realize this analysis is theoretical and it does not represent actual or hypothetical performance of a Betterment portfolio. What? It's theoretical and does not represent actual or hypothetical performance of a Betterment portfolio. What? Then why'd you show it? And so you realize after looking at this white paper that it's really just a bunch of like marketing BS. You can kind of tell that when you read through it because you come across things like this: achieving global diversification with a Nobel Prize winning approach. Nobel Prize winning. Just because it won a Nobel Prize does not mean it's a good strategy for you. This is marketing talk. All right. So let's go back to this email. So you have to log into your account. So I logged into my account and I did actually come to a page that told me a little bit about what was going on. So about the update. What it is, we're excited to bring you the latest optimization, again, that word that doesn't mean anything, of the Betterment portfolio strategy. Our investing committee regularly analyzes, that word that doesn't mean anything, and continually refines, again, doesn't mean anything, our portfolio strategies based on new data and methods for improving expected performance. Which accounts? The safety net. Okay, this is all like similar stuff from the email. What more you need to know? Okay, so now they're like, this is what you need to know. Don't look any further. We're going to tell you what you need to know. This update is a continuation of our dedication to the Nobel Prize winning modern portfolio theory. Okay, so more marketing speak and this appeal to this like 70-year-old idea that you can construct a portfolio with a certain risk and return level. This transition will remove funds that invest exclusively in US corporate bonds because those bonds are included in our existing US high-quality bond funds. Okay, now notice this. They do not say, right, which US corporate bond ETF that they are removing, and they do not say which ETF that they are putting the money into. They also don't say what the expense ratios are for these ETFs. What? I'm not going to look it up right now in the video, but I'm going to put it in the description I'm going to look it up after I finish this. I'm going to put it in the description. So if you want to see if they're sticking my money into higher expense ratio investments, you can look there. Maybe they are, maybe they're not. I'm not sure. For goals with higher risk allocations, meaning higher stock allocations, this transition will also increase U.S. stocks and decrease international developed market stocks. So they are decreasing their international risk. This optimization is based on updated global market capitalization data and a refined portfolio optimization methodology. Refined portfolio optimization methodology. Again, 4 words, multisyllabic, don't mean anything. What did you do? What is your methodology? Why isn't there a link to your methodology? Why isn't there a link to updated global market capitalization data? Why aren't you citing the source of your data? Before determining which of your goals to transition, we conducted a personalized, goal-by-goal analysis of your investments. Well, this isn't very personal because you're not telling me what the hell's going on. Considering the additional long-term expected long-term performance, expected according to what projection? From the new optimization, repeating this meaningless word, as well as its estimated tax impact. Note that this transition will not cause you to realize short-term capital gains. Beginning on June 25th, 2018, we'll start to automatically adjust the investments in each of your goals listed above. Any deposits made before then will move towards the new portfolio weights and reduce the need to sell positions in the transition. Okay. I gotta say, like, this is some typical financial bullshit. If anything, it's a little bit more transparent than some others, but the finance industry has a disease where they're unable to be clear with people about what's happening. Not because it's hard to be clear with people, but because in, 90% of the cases, it's more profitable to not be clear. By keeping people confused, by keeping people feeling like they don't know what's going on, it causes them not to act. And when people don't act, they don't act in their best interest. And when they don't act in their best interest, you can charge them higher fees and you can make more money from them in kind of clever back-end ways. And I don't know if that's what Betterment is doing here, but Betterment is definitely not doing themselves or me a service by telling me that they're adjusting my portfolio and then making it not completely opaque, but like 80% opaque about what they're doing and why they're doing it. It's not classy. And anyway, searching around for kind of like what was going on with this, because I looked at, let's see if it's in here. Maybe it wasn't here. Maybe it's in a different one, where they were talking about their ETF selection. So if I look for selection methodology paper, right? So why do we invest in ETFs? So they invest in ETFs. Okay, exchange traded funds. Now you know. Expense ratio comparison. Exchange traded funds have low expense ratios compared with the industry average. Okay, that's good stuff. Got nothing against exchange traded funds. What? So this is what made me kind of like think like, hey, what's going on here? I looked at this. All ETFs, excluded ETFs, or Betterment ETFs, right? So, and they will actually. This is kind of cool. If you go to the excluded ETFs, they will tell you why they excluded them. They don't like their asset strategy. So you can go to like this one, and they excluded SPY due to segment. Category. Let's see. Click on that. Excluded due to category. So they'll tell you kind of a reason why some stuff was excluded. Total cost. Let's just click on one of these. So excluded due to total cost, VEU, All World Index. Okay. So at least you know why they say they excluded some stuff. Anyway, I went to Betterment ETFs, right? And then I looked at just the top ones, right? So we got Vanguard Total Stock Market Index. That's what I'm talking about all the time. Expense ratio 0.05. Can't really argue with that. VWO, right? This is an emerging markets fund. So these are not developed markets. These are emerging markets. So these are international countries, I guess maybe like China, a lot of the Southeast Asian stuff that are growing, but not quite there yet to the level of like Europe, the United States, and Japan. And so expense ratio 0.15. Okay, that's the same expense ratio as VEU, I think, that we saw before, but whatever. And then EEM. This is another emerging markets fund, right? And it's not clear how it's different from VWO, but its expense ratio is 0.68. 0.68? What? 0.68 is more like this. It's even above this industry average. Why is Betterment holding an emerging markets fund with such a high expense ratio when they already have one with a significantly lower expense ratio, 0.15? So anyway, I looked at this as I was clicking through the stuff, and I was like, that didn't make any sense. And then I came to this Quora article, why are Betterment and Wealthfront's portfolios heavily weighted in international equities? And somebody from Betterment answered, and then he basically said, we're accurately weighted. So they're trying to invest in the world average. That's what he thinks at this point when he answered this question. And let's see. But I think this answer is also it's an interesting perspective on it. By putting more international equities into a portfolio, the back test will look better. For instance, emerging markets exploded from 2004 to 2007. I ran a simulation of ticker EEM, which tracks the emerging market index versus the S&P 500. Look at the difference in returns, right? So looks like the international market exploded and did much, much better than the S&P 500 during that time. EEM returned over 180%. Imagine if you are a robo-advisor and you can show that back test. If EEM makes up 20% of a portfolio, the return attribution will be over 35% of your portfolio. That is huge. Imagine showing that to a client when they sign up for an app. So it's a marketing thing, at least in this guy's opinion, right? Which, you know, I got to say, not that this guy is completely wrong. You know, and not to say that there are some other answers here that basically say, like, let's go see. They basically say that, like, the US market is, like, these international markets are growing, and so if you don't have money in them, you're going to give up those returns. But, you know, I don't think any of this ever answered my EEM question. Yeah, it didn't. I read an article, a different article, where I just said like VWO versus EEM into Google, and the guy said, yeah, they're the same thing, it's just EEM's a lot more expensive. Is he right? I don't know, but he wrote a whole article about it. And so where am I going with this? Because I started out this video talking about how they were being opaque, about how they were changing the investments in my emergency fund. And now I'm ending it with, a discussion of why they're holding two different emerging market ETFs with very different expense ratios. And they're not explaining it well in their white paper, right? I mean, is EEM. I don't want to search Google. I just want to search this page. Come on. No, they never discuss EEM here. They do discuss here total annual cost of ownership, that they have this fund scoring method determined by two components or frictions. But they don't really give you the actual equation. So see, it's like you have to read through all this ridiculous crap to find out basic answers about this stuff. And yeah, that's really the point of today's video, to be honest. It's showing you how easy it is, because I say on this channel, I say keep things simple. It's showing you how easy it is, even like sticking your money into something like Betterment, where it's really plug and play. You just like send them your money and they auto invest it. To actually know what you're invested in and why, even if there are good reasons, not only does it take a lot of reading, but the people doing it don't do a good job of explaining this stuff. And it is frustrating. Because what you'll realize is, like, even after you read all their white papers, there's still a lot of outstanding questions around why they made certain choices, what their methodologies were, and so on. So that is it. And you know what? I'm going to look more into the ETF fees and see if anybody's talked about this today. Anyway, so I'm going to look into it more for me. Don't have time right now. But I hope that this video gave you a little bit of insight into kind of what this investment knowledge world looks like, and what you're going to run into when you try to figure out what's going on. And I think this is, honestly, it's a reason why people need to control more of their own investments. And they need to be simple investments. Because it is so easy to give your money to somebody else, and then they're going to throw up a wall of all this crap, and then you don't know whether you're getting screwed when they make a change or not. You just don't know, and it would take you 8 hours or 16 hours of reading to get close to it. So that's ridiculous, but that's the way the industry is. Okay, that's it for 5-Year Club video number 147. If you are so inclined, I would recommend reading Betterment's white paper, just so you can get familiar with some of these terms. Let's see if we got FAMA in there. FAMA in French, not on this one. I guess it's on that one, right? FAMA. Man, I'm really bad at typing today. FAMA and French, yeah. FAMA and French can be its own 5-Year Club video later. All right, that's it for video number 147. Have a fabulous evening.